All right, so let's just take a look at some of the latest inflation data came out. This is last month's, looks like. But we had the most recent report that came. Oh no, this is the right one. This is for March. Yeah, I'm sorry, Matt. You got the right. You were on top of it. This came out yesterday, April 12th. Looking at consumer price indexing, and that's a basket of goods. How expensive is it compared to last year? We're up 8.5% year over year. Some of the big items were gasoline, up 18% just in March. Other energy components also increased. Food index rose 1%. Food at home increased 1.5%. Now, the one takeaway, I guess the silver lining that some folks are referring to is that core inflation, which is basically CPI, but you're going to take out food and energy because they say it's less volatile. How you take those out and actually get a good picture of inflation, I don't know, but I sort of understand the reason. That was a much more tepid at 6.5%, which isn't nearly as high. I think came in a little bit under what people were expecting because I think just the high gas prices. But really got to look at that top line, just regular CPI. And again, we're looking at the largest 1 month percent change for quite some time. I think we have to go back to the late 80s. So I think 40 year. We're still setting these record high levels of inflation. Fascinating.
Yeah. When I got this report, I immediately skimmed to the section on housing. I'd been kicking myself because I was unable to track down a piece of analysis from a few months ago that found that rental housing is relatively undervalued. And I mentioned this before, that rental housing is up 4.4% year over year, and the total increase for all items is 8.5%, almost double that. Additionally, the 4.4 increase in rental housing was slightly lower than the rise in shelter costs of 5%. So for rental housing, I think that the 4.4% number is actually low relative to what we've seen reported, because the effects of the massive 2021 rent increases are still really trickling through the apartment market. At the same time, the cost of housing is often the largest item in the household budget, like I said, like we talked about earlier. So that 4.4% is a lot more painful than the 23.4% increase in rental cars, the 13.6% in stationary, or even the 35.3% increase in used cars. That last one is actually getting some attention. So
still hard to get a car these days.
I just heard of someone who bought a car 5 years ago, made money selling it.
Yeah, I believe it.
And what's interesting is and my other friend there was a used car and a new car. The used car was worth more than the new car. It's because now it's almost like people are seeing it. They're not out just because it's a year older.
Yeah, that's interesting.
And I wonder if you know how they say the price decreases right after you drive it off the lot. That may not be so true anymore.
Yeah, and again, it's all fascinating because they're supposed to be incredibly depreciating assets. I mean, I've got a truck that has gone up significantly in value. Yeah. It was probably worth about $12,000 a couple of years ago, and I could probably sell for $22,000.
Yeah, it's ridiculous.
It's a Tacoma, so they're in like high demand. Mm-hmm. But I'm like, what am I going to do? And I need my lease on my Tesla's expiring here in the next couple of months. But I've been looking for another option. They're doing another one. It's going to be 2023. Yeah. I put a deposit down for a Rivian. They're like, we'll let you know at some point in the next couple of years. Yeah. What's the point?
It's scarce and valuable when it comes to cars, and it does seem a little bit ridiculous. But then again, these are these are things that people need. Yeah. And especially when it comes to used cars, people maybe are realizing, oh wait, just because it's used doesn't mean it stops being a car. Yeah. And so, I thought that was a particularly interesting thing, just on how it almost boils everything down. It's not about the shiny or new thing. It's about these trucks that can do utility. The work. Yeah. The utility. And that's, and that kind of comes back to, housing prices in general. These are things that people need. And I still think that we haven't seen the full impact of the 2021 price increases, just because, and we've talked about this before, the market rents, the asking rents are have been elevated hugely, but the people that are already living in there, their rent increases are going to come over time. It's going to be a much slower progression.
Well, and that's the big difference between you look at kind of housing in general and CPI compared to like market growth, because you have to, they're taking into account everyone who already has a mortgage, who's already bought a house, who already has a lease, and not just looking at what, if you're going out to buy a house today or rent an apartment today, what that growth is.
Yeah.
And so when you factor all that in, it's obviously a lower number, and that's where the new and used car sales are really incredible.
Yeah.
So switching from the consumer price index over to the producer price index, these are like inputs. This is like what goes into making all the stuff. And people will say that the CPI is a lagging indicator because it's like what people have already paid. PPI is maybe a little bit of a forward-looking indicator because this is like the materials that go into the stuff that's going to be made that people are eventually going to buy. And it is up quite a bit as well, increased 1.4% just in March. That's a huge just monthly gain itself. So we're going to continue. I mean, look at this.
So just compared compared to the CPI, the year-over-year increase for the PPI was 11.2%, and the year-over-year increase for the CPI was 8.5%. So if it is a lagging indicator, then we may see CPI move even further.
Yeah, even further, which again goes against a lot. Again, we've talked about this a lot. There's a lot of models. There's a lot of projections who are basically saying that demand and growth is going to just tailor off near the end of the year. It's just going to disappear. And the only good piece of evidence for that is demand destruction because of high prices. People are just going to be squeezed out. They can't pay anymore. But when we're looking at all the data of just where prices are continuing to go, there's not a lot of evidence that it's just going to just fall off immediately. Especially war in Ukraine, other supply chain bottlenecks. And we've complained also, looking at some rent growth projections and forecasts. I think people are trying to play it relatively safe.
Yeah.
And they're basically simply just trying to revert to the mean as quickly as possible. As I think that they are afraid of saying that there's going to be 10% rent growth this year or even more, when we already saw year over year in March 15% rent growth. So we're seeing stronger rent growth in not even the peak leasing season. We're just getting into leasing season. We're seeing CPI. We see how much more housing rooms has to go, and we are seeing wage growth. And so that kind of adds to that wage price spiral. I don't see how rents aren't going to have another, maybe not record year, but it's going to be pretty strong. And that's more than I thought. But a lot of these projections, they're really kind of pulling the projections out of thin air and trying to just kind of temper everyone's expectations, which I think is probably healthy, but I just don't think it's necessarily the reality that we're going to see.
Yeah, I wonder, and I'm sure it wouldn't be too hard for me to find out, is what's the lag time? We're talking about leading indicators. What's the lag time between a Fed rate hike and the impact it has on the economy? And when are we going to start seeing the demand that they promise is going to go away actually go away?
Yeah.
Because it's a promise that that the Fed has tried to kind of psychologically program us that this might happen. But
well, at least it's moving like like the stock market. Those markets are moving. Those react right away. But how it affects the actual economy, I think that's a bigger question. I think it is much more delayed. It's not until it kind of trickles down through kind of markets, and all of a sudden people have to be, the job market cools down. People aren't getting raises. The wages aren't growing. People even getting laid off. Once that happens, then it's like, oh, now we're in a recession. By that time, the stock market is now maybe even growing a little bit because they're pricing in that recession and interest rates falling. So you have to look at kind of these different, where the actual economy is, reality, and that's where apartments and real estate usually lie. I mean, you still have buyers and renters. They're not looking at CPI. They're not looking at inflation. They understand that things are a little bit more expensive, but they're not necessarily reading the open market committee minutes to making their everyday decisions because they're like, well, CPI is up a little bit. I need to temper my purchases. They're looking at their pocketbook, their bank account, which people still have record savings levels, and they're making decisions for what they're making on a day-to-day basis. So it is delayed.
Pent-up demand was such not an excuse, but it was such a justification for a lot of the inflation that we've seen, a lot of the continued demand. I wonder if there's still some pent up demand ready.
I think there absolutely is, and the people are taking advantage of it. I mean, we're seeing it in hospitality right now. I mean, I think I was looking at some hotel prices, looking at going on some trips, just later in the year, and hotel prices are like, they are double than they were a year ago. We had Alex and I, we had some trips scheduled, first in 2020, and we kept canceling it because there were the lockdowns and everything. The prices of those rooms have doubled and sometimes more than doubled from when we were first looking at them. Yeah. I mean, where it's like you get you go to a really nice hotel, maybe you're paying $500 a night for a room, plus or minus. Now those are all like $1,000 more on peak times. They're like $2,000. Like we were looking at a place down in Cabo and it's like $4,000 a night. I'm like, that's not.
Yeah,
who's paying that? A lot of people are paying it.
It's all like you could see two different possibilities right there, because short of this, this kind of frenzied and anxious environment, whether it's a recession or Fed tightening, if you take that out of, if that wasn't in the picture, man, I would be looking at places like Orlando and Tampa and Naples. All of these Sunbelt cities would be deservedly good places for investment because there's going to be tourists coming in there. That's going to require a larger workforce, and that's really could drive so much of that market, which is still going to happen. Yeah. But there's a lot more uncertainty now that
I think there's uncertainty. I think they are going to still see the growth because of that.
Yeah.
And people will continue to travel. Even it has to get deep into the recession for people to finally say, "Oh, I'm not traveling." And people, once you're out of the recession, people are still nervous and they're shell shocked. I mean, remember kind of 2009,
I know,
2010, 2012. People were still like, no, in this economy, I'm like, well, there's actually things are looking relatively decent right now. So in context, Matt, you wanted to bring this up, and I think this is a good point. Looking at, the United States is not alone. I mean, this is inflation rate by country in 2022. Pretty much everyone is in a pretty similar boat.
Yeah, it is interesting. Just looking at the, and I don't know a perfect way of translating this, but it does seem like much of Europe is experiencing the same amount of inflation in Australia as the United States. Now you could use this to say, oh, it's not the Fed's fault. It's not the current administration's fault.
It's central banks around the world and other central banks like the ECB. They're even more dovish than the Fed is. The Fed is relatively more hawkish, which is why we've had higher. They've all had negative interest rates in the past, and we still had positive interest rates. We hadn't gone negative on actual nominal rates, and so they're seeing even more inflation. And in Europe, they've got the war in Ukraine is affecting them much more than it is in the United States, even though we're still feeling some of the impacts.
Yeah, what it does instead, I don't care about reasons or whatever. It illustrates the size of the problem and the difficulty that the Fed and everyday Americans are going to have to kind of get over this problem. It's not going to be an easy switch, and it may have it may have some staying power despite what the Fed tries to do in the short term.
Yeah, I agree.